Hey there, if you want to stay up to date with the latest on global events, make sure to follow S News. Don't forget to subscribe, like, and leave a comment to support us and catch all our future videos. The Middle East is, honestly, one of the most complicated regions in the world. Right now, there are 3 ongoing wars, with major global powers taking increasingly opposing sides. You know, the region has seen conflict after conflict going all the way back to the 20th century. But amid all the uprisings, civil wars and rebellions, 2 countries always seem to be involved: Israel and Iran, the 2 giants in the arena. Before becoming regional powerhouses, both had their fair share of economic ups and downs. From foreign occupations to orchestrated coups, their histories have led to the current tensions and indirect conflict between them.
For now, it seems like Israel has the upper hand. One big reason is GDP. Israel's economy is worth over $500 billion, while Iran's stands at around $400 billion. On a per capita basis, Israel's GDP is over 10 times higher than Iran's. That kind of economic power lets Israel invest in a much stronger military, even though its population is about 75 times smaller.
But here's the twist. It wasn't always like this. Back in the 1970s, Iran's economy was booming. In fact, by 1986, Iran's economy was nearly 6 times larger than Israel's. So the question is, how did Israel pull ahead while Iran fell behind? Most people still don't realize how Iran went from being an oil-rich powerhouse to a struggling economy, or how Israel went from a war-torn state to a tech superpower. To understand this, we have to go back to the roots. So instead of focusing on the economy, Israel had to focus on survival and military expansion. With hundreds of thousands of immigrants pouring in, the government's top priority was providing basic necessities: food, shelter, and jobs. To manage all this, Israel adopted a top-down socialist economy. Labor unions owned and controlled much of the country. Communal farms and cooperative villages called kibbutzim were common because people had to stick together to get by. Support also poured in from the global Jewish community, providing Israel with billions in financial aid. Germany, as part of reparations for the Holocaust, also gave large financial support. Israel's story really is something else. From nothing, to a global tech hub. At the start of the 20th century, Israel didn't even exist yet. The land was called Palestine, and its economy was mostly based on agriculture, run by the native Arab population. But things changed fast during and after World War II. A massive wave of European Jews immigrated to the area, eventually establishing the State of Israel in 1948. The early years were honestly pretty chaotic. There was constant violence between Jewish settlers and Palestinian residents. Neighboring Arab countries also launched wars to stop the new state from forming.
Still, by the 1970s and 80s, Israel's economy was, pretty much falling apart despite all the outside help. A centrally controlled economy doesn't always work long-term. Israel suffered from a massive trade deficit, low productivity, and stagnant growth. Public debt kept rising, mostly due to continuous wars with its neighbors. The Six-Day War in 1967, the Yom Kippur War in 1973, and the 1982 Lebanon War. These wars were funded by printing money, which caused extreme inflation.
In 1970, inflation was around 10%. By 1980, it had jumped to 125%, and by 1984, it hit a staggering 385%. The economy was basically collapsing. Living standards were falling fast.
To fix things, Israel launched an economic stabilization plan in 1985, with help from American economists. The biggest change? Switching from a centralized economy to a free market one. The government and labor unions pulled back, and economic freedom increased. That was the beginning of 4 decades of rapid growth, transforming Israel into one of the most advanced economies in the world.
Iran's story is really different. Rich in oil, but poor in progress. In the early 1900s, Iran was just like Israel and Palestine, an underdeveloped agricultural economy. But everything changed in 1908 when oil was discovered. A lot of it. Iran had about 10% of the world's oil and 15% of its natural gas. That could have made Iran incredibly rich. But for decades, most of the profits went to Britain. The Anglo-Persian Oil Company, which later became BP, held exclusive rights to extract and sell Iran's oil. The British Navy even occupied parts of Iran during both world wars to protect those oil fields. Naturally, Iranians weren't happy.
In 1952, Iran's Prime Minister nationalized the oil industry. But that didn't last long. British intelligence and the CIA launched a coup, Operation Ajax, that overthrew the democratic government and handed power back to the Shah, Iran's monarch. The Shah agreed to share Iran's oil with Western companies in exchange for protection and personal wealth. That betrayal is a big reason why so many Iranians distrust the West. It wasn't about helping the people. It was about securing the oil. By 1954, Western companies agreed to give 50% of oil profits to Iran. It was still only half, but the revenue had a huge impact.
By the late 1970s, unrest was growing. The Shah's brutal secret police, known as Savak, cracked down on dissent, but opposition was coming from all sides: communists, liberals, nationalists, and religious conservatives. In 1979, a revolution broke out. The Shah was overthrown and a group of radical Islamists took over, not because they were the most popular, but because they were the most organized. This marked a major turning point in Iran's history, politically and economically.
Before the revolution, both Israel and Iran had issues with centralized government control, but Iran seemed to have the edge, thanks to its oil wealth. If you'd told someone back then that Israel would one day surpass Iran economically, they would have thought you were crazy, but that's exactly what happened.
Israel's 1985 economic reforms were the game changer. The government privatized state-run companies, ended price controls, and simplified taxes. These reforms came just in time as global trade barriers were falling and Israel integrated into the world economy. In 1991, over 1 million Jews from the Soviet Union immigrated to Israel, causing a massive population boost. Most of these immigrants were highly educated and had significant professional experience. Then came the Oslo Accords in 1993 between Israel and the PLO, which sparked another wave of skilled migration. The peace process and talk of a two-state solution made people feel like Israel was finally becoming a safer place after decades of conflict. That new sense of security also encouraged foreign investment. During the tech boom of the late 1990s, Israel became a hotspot for venture capital. Combined with all the immigration and optimism, this led to a huge jump in Israel's GDP. In 1985, it stood at $29 billion. Just 15 years later, it had grown nearly fivefold to $136 billion. There was a brief recession in 2001 and 2002 after the dot-com bubble burst, but then Finance Minister Benjamin Netanyahu stepped in with a new round of economic reforms. He shrank the size of government, cut subsidies, and lowered taxes. That kicked off another era of rapid economic growth. Israel's economy doubled in less than a decade and kept growing steadily, reaching a GDP of $566 billion.
Yeah, it's truly remarkable how those reforms and waves of skilled immigrants transformed the country's economic landscape.
Israel also made major advances in technology. Today, companies like Intel, Google, Microsoft, and Apple have major operations in the country. Over 400 multinational firms have R&D centers in Israel.
There's also a thriving Israeli startup scene in cybersecurity, AI, medical tech, agricultural tech, and defense technology. In many ways, it rivals Silicon Valley. Israel has the highest number of startups per capita in the world, and it's third in terms of the number of companies listed on the Nasdaq, behind only the United States and China. That's pretty incredible for a country with fewer than 10 million people.
Aside from its booming tech sector, Israel also benefits from access to global markets. Its trade to GDP ratio is about 58%. Back in 2007, it was 80%. For context, the United States has a trade ratio of 25%, and China is around 37%. In other words, Israel imports and exports a lot. Its top trading partners are Europe and China, but by far its number one trade partner is the United States. And the economic relationship with the United States goes far beyond trade. Over the years, Israel has received massive amounts of American military and economic aid, making it the largest recipient of US aid by far. Adjusted for inflation, Israel has received $310 billion in American assistance since its founding. Part of that is thanks to strong pro-Israel lobbying in the United States, especially through groups like AIPAC and the American-Israeli community. In politics and economics, having the right allies makes a big difference.
Now back to the core question. Why did Israel pull ahead of Iran economically? To answer that, we need to look at what's been happening in Iran all these years. One thing's for sure. The Islamic Republic hasn't done well economically.
Yeah, absolutely. Iran's struggles really stand in stark contrast to Israel's economic trajectory.
Right after the 1979 revolution, one of the first major events was the takeover of the U.S. Embassy in Tehran. Iranian students held American diplomats hostage, which triggered the first round of U.S. sanctions.
The US froze over $12 billion of Iranian assets. That was more than 10% of Iran's GDP at the time. Things got even worse when Saddam Hussein invaded. The Iran-Iraq war dragged on from 1980 to 1988, killing hundreds of thousands and wrecking Iran's infrastructure, including oil facilities.
In 1984, the US labelled Iran a state sponsor of terrorism and added more sanctions. Yet Iran's economy didn't completely collapse, mainly because oil prices were high in the early 1980s. Iran could still sell enough oil to offset the damage from war and sanctions.
But that all changed in 1986. Saudi Arabia massively increased its oil production, crashing global oil prices. They did it partly because other OPEC members were cheating on production quotas, and partly to weaken both Iran and Iraq. As a result, oil prices dropped from $28 to $14 a barrel in just 1 year. Iran's profit margins were wiped out and its GDP plummeted. In 1986, it hit a peak of $64 billion, but by 1993 it had fallen to just $29 billion, less than half.
The oil price crash wasn't the only issue. Iran's currency also tanked. After the revolution and war, wealthy Iranians pulled their money out of the country. A massive capital flight. The rial collapsed. In 1978, $1 got you about 70 rials. By 1999, it took almost 10,000. This currency collapse hit GDP hard, since GDP is usually measured in US dollars.
But the real problem was bad management. The Islamic regime ran a centrally planned economy with state-owned companies, heavy price controls, and minimal free market policies, basically repeating the same mistakes the Shah's regime had made. Inflation remained in the double digits for years, productivity and efficiency were both low.
Things seemed to be turning around in the 2000s. Iran's GDP surged from 110 billion in 2000 to 644 billion in 2012. By then, Iran had leapfrogged past Israel again, mostly thanks to, once again, high oil prices.
OPEC was more stable and global demand was rising. In 1998, oil was just $13 a barrel. By 2012, it had jumped to $112. This oil windfall allowed the Iranian government to invest in the economy. They even made real reforms, including a huge privatization push. The government sold off state-owned businesses and started opening the economy.
But even during this reform era, the government still owned 70% of the economy in 2006. So while things improved, government control was still a major issue. Iran also expanded trade ties with countries like China, India and Turkey to compensate for strained relations with the West. A growing population also helped, from 37 million in 1979 to 92 million today. That meant more consumers and more workers.
Still, things eventually went downhill again. In the 2010s, Iran's economy fell apart again. One big reason: the government spent oil money too freely. Iran had one of the world's most generous subsidy programs, covering food, fuel, housing, education, and healthcare.
In 2010, they tried to fix that by replacing subsidies with monthly cash payments to citizens. But this created more inefficiency, especially with low productivity. It worked for a while, until oil prices crashed in 2015, dropping from $100 to $52 a barrel. There was a brief recovery in 2018, but prices tanked again in 2020. Russia's invasion of Ukraine gave oil a short-term boost in 2022, but prices are falling again.
Bottom line, running your economy on oil-funded handouts isn't a stable strategy. It might help short-term, but it's no good in the long run.
Finally, thanks so much for listening and sticking with us. Be sure to follow S News and keep an eye out for future videos. And hey, don't forget to subscribe, like and comment.